All right, this is Ubaid on behalf of V Electronics, and in this video, we'll be continuing from the last video, and we'll look at how the inflation as well as the recession impacts your aggregate supply model or the aggregate supply curve. All right, so when it comes to your aggregate supply curve, okay, suppose this is your aggregate supply. All right, and suppose this is your aggregate demand over here. And let's say this is your potential GDP somewhere over here. So what's going to end up happening is as inflation kicks in, okay, the cost of materials, okay, minerals, materials, okay, such as gasoline, crude oil, so on and so forth, may go up, as a result of which your aggregate supply curve will shift to the left. Okay, so this becomes your AS1 over here. And as it becomes AS1, your new equilibrium point means your price levels will go up and your real GDP, because this is real GDP over here, will go down. Okay, so your economy will shrink. All right, despite the fact that initially the demand may cause the economy to go up to a certain extent until it starts dropping back again. Okay, the aggregate supply around the same time will cause the GDP to go down. Okay, so the net impact, okay, may be a little less or a little more of GDP, depending on whether the aggregate supply is successful in shifting the GDP towards the left more than the aggregate demand curve is successful in shifting the GDP more towards the right, okay, or vice versa. All right. So the net impact may depend on how much the aggregate supply or the aggregate demand curve is successful in shifting the GDP either to the right or the left. All right, so this becomes your new equilibrium point. This was your original equilibrium point. Let's say this was E0. And let's say this is your E1. And because this is your E1, okay, what ends up happening is, okay, your real GDP, your economy shrinks. Okay, your economy shrinks. And this may be magnified using a monetary policy where the Federal Reserve Bank, for example, the Central Reserve Bank, the Fed, may pump money into the system by buying bonds from banks, okay, which may lead to devaluation, okay, of money, okay, which may lead to, let's just say, inflation, okay, and because of this inflation, okay, the federal bank may go ahead and bump up their interest rates. Okay, so initially, because of inflation, the interest rates may be down. Okay, and the government may be involved in this as well. Usually it's just the Central Reserve Bank. Okay, so the government may be involved using the fiscal policies. The Central Reserve Bank will be involved using a monetary policy. Okay, so if the central bank goes ahead and reduces the interest rate, okay, as well as buys bonds from the banks by pumping money into the system, okay, it will cause inflation. So that will cause inflation. All right. However, the federal bank, the Fed, or the Central Reserve Bank, okay, they're all the same. Okay, if they go ahead and increase or bump their interest rates up, what's going to end up happening is, okay, your interest rates will go up, which means the consumers, okay, consumers at home will go ahead and invest more than borrow or spend, okay, which basically means that your real GDP will go down because personal consumption makes up a big chunk of real GDP. As a result of real GDP will go down. Okay, because your real GDP goes down, okay, your economy will shrink eventually. And because your economy shrinks, okay, you will have a recession. So your inflation, okay, follows a recession. Okay, and a recession may follow or may be followed by a deep recession, what some people call depression. Okay, so if this depression continues, if the recession continues, it will lead to high unemployment. Okay, as the economy falls. All right, and this is all because of aggregate demand and aggregate supply. All right, so on behalf of B Electronics, this is Obey. Have yourself a great day.